Alright guys, it's John here again, and today we're going to look through the stock market. I'm making this video because I don't think people realize how far blown out the stock market really is when you compare it to historical averages. And I'm not a financial advisor yet, and so this is not financial advice. This is simply a guy, y'all who know me know how much I care about people. So look at this as your son or somebody, your nephew, talking to you just about the stock market and just trying to show you what it all means. And I'm going to move this over here, make it a bit smaller. Alright, so the first chart we're going to be looking at is the Dow Jones Industrial Average. We're starting back here in the 1897. And just trust me on this, we're going to paint a picture. And I've got my notes right here, so if I keep looking to it, just know that. And then I also have notes down here. And I will talk about that later. So we're going to go through the decades here. As you can see, we start like in 1897, which is a long time ago. And you can see that roughly it starts around 28 points. And here, actually, let's zoom in a little bit more. That way we don't get the roaring 20s. This little orange line is the 20, or it's the short-term moving average, pretty much. This blue or teal line right here is the long-term moving average. So right here is the onset of World War II, or World War I, the Great War, as they called it, if I'm not mistaken. We can see this drop right here. We can see that it kind of moves with news about the war. It's kind of really what stock markets do during and before. And then we can see that the roaring 20s is when America really starts to pick up here. And people are living lavishly, living the good life, even though if it really wasn't moral in terms of being godly. But that's for my next article that I'm writing, so check that out when it comes out. And so here we see the roaring 20s, just this complete blowout from anything that was prior to the 1920s. Like this is 118, this is 300, so that's pretty much a 3x onto it. And so we're about to see the Great Depression here, but it almost hits 400, so almost a 4x in the span of a decade. And we see the Great Depression, we have these, it falls and then it comes back. Make sure I'm not missing anything. Okay, I'm not. We're just following through right here. And so you can see these fake breakouts. The market really does this. I can't say who. Definitely now it'd be institutions kind of trying to rally the market back in order to get a better selling price. Or it's just people thinking that it's going to get better. And it's really not. And so we can see that it breaks through the short-term moving average and then the long-term moving average as well. And it goes back all the way. When did we see a 40? We saw a 40 around, let's see. We saw 40 around 1903. So it pretty much wiped out the past, what is that? What is this? 36 years worth of value, or 26 years worth of value in the span of 4 years. And so that was just pretty incredible. We see this with the New Deal coming through and trying to build up America's workforce by getting them back into jobs like the TVA and stuff like that, which was really good at the time, even though if there was some policies that some people don't like, with like the gold, but they still got paid for it, so it's not like they just confiscated it. We see here World War II coming about, and we can see, America's really taken the place as a superpower in the world here, and we'll see it even more so after the Bretton Woods, which is around 1950 or not 1947. Sorry. And so then now we just have the manufacturing base. This is the Great Generation, building everything to what it should be. We have an incredible nation here. And just remember that 16 years earlier, the Dow was at 40. In 1949 it was at 160, and then by 1955 it's up at 421 at the high, and it just continues to keep climbing. We're still in, let's see, I'll zoom this out a little bit, make it go a bit quicker. And it's just still climbing here. We're about to get to the Vietnam War, which kind of put a damper on our currency just because of the excess spending that we had to do. And so the dollar kind of lost a lot of value. But, I mean, you can see the Dow is still trucking along here. Then we get to 1967. I think that's when we officially joined the Vietnam War, even though we were there around 1962, I believe. And so now we enter into 1961, the 1970s, I'm sorry. And this is when the gold crisis was coming about with Nixon protecting the dollar against the speculators, as he would always say. I think he had a really funny voice, I'm not going to lie. And so we see here that the 1970s with the oil embargo in the Middle East, you know, this was a really tough time for America. We had stagflation, we had interest rates peaking around 22%, which is just astronomical. I can't even imagine. But I do foresee that in our future, unfortunately. And so we have this just decade of really a lost decade. And what Paul Volcker did here, he was the Fed chair, breaking the back of inflation, raising interest rates to, I think, 25% to break off inflation. Or 22, I'm sorry. And so when Reagan comes in, he deregulates everything, and Reagan really didn't do much. He really just he came at the right time, you know. And so we had the 1980s. I mean, the Dow doubled in a span of, was that 5 years? And in a span of, oh no, this is 5 years. It's almost, yeah, more than doubled. Okay. And then 1987 computer crash, kind of, that's a whole nother story. But I mean, you see how quickly it bounced back. This happened in 87, and by 89 it was back to where it was. And then we have the 90s, the onset of technology and computers, the internet coming about, and this is just a really profitable time for firms. And so the stock market really had a lot of froth, and it was going up. Remember, this here is the long-term moving average for the market. This is the short-term moving average. So we can see it kind of gets away from the short term, and it's still been a long ways away from the long term. And we see that, was this 1997, it was at around 7,700. And in 1987, which is the crash, so we'll go a little bit back from that, it was around 1,800. So in a span of a decade, it gained almost 10,000 points, or 7,000 points, I'm sorry. And then we had the dot-com crash, you know, coming up here in a second. Boom, boom. And then we really just rose right back. It really didn't put much of a dent. This was more in the NASDAQ rather than Dow Jones, so that's another variable. And then we have the 2008 recession. This is one of the first times in a long time that it actually broke through the long-term moving average, kind of self-correcting itself. But as I zoom back out here, we can see that it didn't take long. It took about, I think, 4 years for the market to get back to where it was. And from the onset of Trump, I mean, we took off here. This is COVID. COVID literally only... COVID dipped 2 months, and then in April it started rallying back, and by December it was already back to where it was in February. So here we had the inflation when gas was like $5. Thanks, Biden. And so now we are here. This would have been Liberation Day last year, and this is the onset of Iran war, and we're back to where we were. So I want to go back to the all, and this is what we're looking at here when we see the Dow Jones Industrial Average. I'm going to check my notes here. Okay. All right. And so the linear scale, this is the linear scale. It tracks the dollar moves. So this is more of the showcasing the value in which the market is really in. And as you can see, I mean, this right here is 2000. This right here is 2008. And since that point, we've almost 4 times increase. And this kind of parabola that we see is not really normal. But I'm also going to show you the logarithmic form, which shows the percentage moves. So right here, remember on the linear scale, we saw that the Great Depression really showed a dramatic change. When on the linear scale, when you're zoomed out, it shows nothing. But with the logarithmic scale, it shows the percentages move. It really equalizes. It focuses on the percentages. And so you can see this massive drop off here of 89%. And also one thing I want to show you is this point right here is 10,000. 10,000 for the Dow Jones average. So basically 102 years it took the Dow to reach 10,000. And now, in less than 26 years, it's now at almost 50,000. So in the past 26 years, it's risen almost 40,000 points. It's right here. And so my thesis behind all of this is just showing the fact that we are, I got to do that as well, that we are very overblown. Like these minor crashes right here, the Great Depression right here, well, not the Great Depression, these minor crashes right here don't even show up on really the logarithmic scale. You know, they're right here. COVID, which is right here, is just a minor blip. And the fact that we think this is a normal thing for the market, like if you see this teal line right here, that's the long-term moving average. We are more than double the long-term moving average right now, which is not normal at all. Which means that if we had a healthy market correction, we would see the Dow go back down to around 24,000, probably 30,000, just because of the premium of being the United States. But let's say that we had a Great Depression type thing again. We had an 89% drawdown. I want to show you what that would look like. And I actually got to go this way. And we'll do the date and price range. And it's about to 89% is about right there. Oh, hold up now. 89% is right there. So if we had a crash like the Great Depression, that is how much value would come off of the stock market. Now, I'm not saying that we will, but if history tells us anything that we've known before, the Roaring 20s were a lot like the Roaring 2010s and Roaring 2020s. We see right here, this is 2010. We see just a rapid rise. Do you remember back here? We saw a rapid rise in the 1920s. Let's see. You see this kind of just rapid rise up here that really was not founded upon anything. Yes, we had Henry Ford, but it was really just debt speculated, which honestly today's world is as well. And you see the moving average there. So I'm not calling for a crash. I'm just saying be careful, because when you look at the technicalities of the market, if we had something like the Great Depression, we would see it drop all the way down to around 4,400. Now, even if we didn't have that kind of drop, if it dropped 50%, this is where it would be, and it'd be back around the 25,000 range. Now, I'm not saying that will happen, but I'm just trying to convey the urgency of kind of it's like a balloon. You know, you can keep blowing into the balloon, you know, trying to puff it up, but at some point it'll pop, and you don't know when that point will be, but you know that it could happen the larger and bigger and more air that gets into that balloon. So now we are going to move on to the S&P 500. We're just going to go through this as well, kind of quicker than the Dow Jones, because that was more the preliminary thing. But even the S&P 500, look at this moving average here. It's more than double it. and the logarithmic, you know, it just show we are above trend lines. And you see, this is .com, this is 2008, this is COVID right here, or no, this is the inflation, this is COVID right here, and then this tiny little blip is the Iran war. And so you can see that really the percentages compared to past oh goodness, sorry, I accidentally opened up Excel. 1 second. It's a bad thing about a Mac. Alright, but once we get back to kind of, you know, a state of normalcy, it will take a lot to get back to that point. And I will move down to the NASDAQ. NASDAQ is extremely overblown, over 3 times the long-term moving average. And you can see that we haven't had a sort of percentage drop like the .com crash in a long time. And the thing about this, that my reasoning for doing this video, is a lot of international markets, if not all of them, are extremely above their moving averages, meaning that if we had anything like a Great Depression, Great Recession, .com crash, we would see enormous amounts of value just stripped away from the stock market, and a lot of people would be left holding the bag because they've been told that this is normal, Let's see, let's just do 10 years. Let's do 2016. They've been taught that this kind of rise is normal. At the onset of 2016, the stock market, or the Dow Jones, was at 18,285. Now it's hovering around 50,000. That is not a normal thing for the market. And some could say, you know, well, this is just due to better technology, better stuff like that. Kind of, you know, but that doesn't mean that it's normal to see a growth rate like that. A CAGR, compounding annual growth rate, is around 7% since the .com crash for the S&P 500, which is just unheard of. And so we will, alright, and now we're going to keep going on to the international markets. Actually, hold the phone. We're going to show what it's like since COVID, if we can, without my computer bugging. Maybe not. Alright, we're just going to have to do it. Alright, we'll do it on the Dow. Dow will work. Alright, so you see right here, this is from COVID. The low of COVID, 17th. I mean, this is just, it's unheard of. Okay, and now we go to the German stock index. We can see that it's really blown out in the past couple of years. You can see that just it's diverging from the moving average, which is not a healthy thing. This is the France stock market. This is Japan, which Japan has already seen a rapid rise in their economy before, and this happened during the late 80s, and it literally took them 40 years to get back to that point in 1989. And it's just, and look at them now. I mean, it's the complete exact same thing. And you might say, well, it's Japan. Well, Japan is further ahead of everybody else in the world. They've already had this, and now they're back here. And now we're playing kind of catch up on the global debt. I mean, I think they're 230% debt to GDP. We're around 120, 130. And with the increase in debt that we have, and the fact that we have to pay it off each year, and we have to keep on, you know, issuing new debt to pay off old debt and stuff like that, it's just a snowball effect. This is the Kospi. This is South Korea. In the past year, it's gone bazooka, and that honestly frightens me, because in the past year, it's, I think, grown like 5,000 points, which is just not normal at all. I'm going to close out of a couple of these. I think it's slowing down. Pardon me. Get rid of that. I like Germany. Germany's a good one to show. Let's try and reload it here. And then let's go to the 1 year. Okay, perfect. All right. So the 1 year, get off of that. This is the 1 year chart for South Korea. And honestly, it baffles me. I mean, it's almost 3x, 2400 to 6400, and if it is 7200, that means it'll have increased. I think was that 300% in the past year. And this is we are living in a period of just exuberance and the Roaring '20s, pretty much. I mean, this is the Roaring '20s again. History doesn't repeat, but it often does rhyme. This is it rhyming right here. This is, I believe, yeah, this is India. Okay, India, they're off the moving average. This is Brazil, again off the moving average. They have a failing currency. This is this is Mexico, off the moving average. This is Argentina. Argentina is just, I mean, this is way worse than anything I've ever seen. Like, you see this channel, and then you see this just breakout. That's not normal. And so what I want to go through here and focus back in on America. And so I want you to think about gold. I want you to think about it as an investment, it as a currency, it as just a baseline in which pretty much everything in the world kind of revolves around, as a store of value. Okay, yeah. So gold can't be printed like the dollar can, so it can't be debased. The supply is fixed. And so we're about to take a look here. This is the S&P 500 valued in gold. So how much real wealth has the market created? When you price stocks in gold, you strip out the dollar debasement entirely. And so during the dot-com crash, 5.59 ounces of gold to buy the S&P 500. Okay, now it only takes 1.48 ounces of gold to buy the entire S&P 500. This is not good when you see the fact that the Dow Jones or the S&P 500 is at all-time highs here. Yet, when denominated in gold, it is breaking down. I mean, it's in a bear market here. It's below the moving average, and it's continuing to go down. And so that means that all the nominal gains created from the stock market really aren't being outpaced by gold at all. Let's see. Okay, the two friends analogy. Friend A puts money into the S&P 500 in 2000, watches it go from 1,500 to 7,000. Feels like a genius, thinks he's 4x'd his money. Friend B puts his money in gold in 2000. Gold goes from $270 an ounce to, what is it now, 4,700. And so friend A didn't beat friend B. He got destroyed. He just didn't know it because his statement is in dollars that keep shrinking in value. Okay, and objections against this statement. Couldn't the SPX just be outperforming the dollar? The answer is that SPX denominated in gold or divided by gold already absorbs dollar weakness automatically. Gold rises when the dollar weakens. So SPX and gold divided by gold collapsing while the dollar weakens means stocks are losing even after accounting for debasement. We'll go here to the SPX denominated in the DXY, the dollar index. This right here is the, we're going to have to reload. Sorry about that, guys. Hopefully it stays. It does. Alright, we're going to go in a little bit here. This is from the past 5 years. The past 5 years, you know, it kind of shrunk back down here when inflation, we had to increase interest rates, strengthening the dollar and everything. But it started at 45, high of $72. But when we go back out, and I kind of already gave you a spoiler, you can just see that when denominated in dollars, the S&P 500 is just insanely going out. And now we are going to go to the moving average right here. Bear with me. I'm sorry that I'm looking down. I'm trying to, but this is just a lot of information, and I kind of want it to be like a conversation. So just bear with me. I know it's not a perfect video, but the moving average, long-term moving average, is at 31. Yet it actually sits around $72. Or 72 points, which is insane. The analogy for this is if I gave you a ruler and quietly made it shorter every year, everything you measured would appear to be growing, but your table didn't get bigger, your ruler got smaller. That's pretty much the US dollar since 1971. When we look at gold here, let's see, gotta reload her again. And you just look at gold, and this is not healthy at all either for gold. This means that the currency in which it's denominated in is collapsing. You can see the long-term moving average is 1,700, yet it's around 4,800. I mean, this is just insane. And let's compare the M2 money supply to it as well. New pane. And you see, this is 2020, and since that point, in 2020, gold was hovering around $1,500. The money supply was sitting around 15 trillion. Since then, we've added almost more than $7 trillion into the the economy, and gold has more than doubled. And so, my reasoning for showing you this, is the fact that the economy in which we live in is not normal. Let me full screen me real quick. The economy in which we live in is not normal. We may think it's normal just because, we kind of, I don't know what that would be. Either that's like long-term bias or recency bias, in which people forget how things used to be because of their new normal. But like the inflation numbers since 2020 for groceries, I mean, I think I remember steak being 30% higher than it was 6 years ago. Chicken around the same thing. The amount of inflation that we've seen is enormous, and it still is enormous. We printed, I think, a full percentage point high, or full percentage higher on the CPI, basically the core producer index, or consumer price index, I'm sorry, which is kind of a gauge of inflation, a full percent higher in the past month, and that's when the onset of the Iran war kind of started. There's no telling what April will show. Kind of gas prices have been slowing down, but if this doesn't get finalized and have, a definite end, there's no telling what we'll see. And so I bring this up because I know I'm kind of the boy who cried wolf. I keep on talking about it. But let's go back to my website here. And let's go to one of the first things I ever did. It literally took me months to write this. About Revelation 18. And we are going to go to the biblical integration. If you haven't read this, I highly recommend you read it. It's like 45 minutes long. But I'm telling you, it's well worth it, and I need to do an update to it. I really do. And so I'll do that for myself if you'll read it. And so Revelation 18:3, 9 through 10 say, "For all nations have drunk of the wine of the wrath of her fornication, and the kings of the earth have committed fornication with her, and the merchants of the earth are waxed rich through the abundance of her delicacies. And the kings of the earth who have committed fornication and lived deliciously with her shall bewail her and lament for her when they see the smoke of her burning, standing afar off for the fear of her torment, saying, Alas, alas, that great city Babylon, that mighty city, for in 1 hour is thy judgment come." 11 through 13 says, "And the merchants of the earth will weep and mourn over her, for no one buys their merchandise anymore, merchandise of gold and silver, precious stones and pearls, fine linen and purple, silk and scarlet, every kind of citron wood, every kind of object of ivory, every kind of object of most precious wood, bronze, iron, and marble, and cinnamon and incense, fragrant oil and frankincense, wine and oil, fine flour and wheat, cattle and sheep, horse and chariots, and bodies and the souls of men. And so this kind of goes into our biblical parallel, like what the Bible means kind of if we put it in today's world. Luxury goods, the global luxury market does $1.5 trillion annually. Supply chains span 20 plus countries per product. The biblical parallel, fine linen and purple, maybe modern fashion industry globalization. Raw materials, wine and oil, fine flour and wheat. Agricultural commodities, 80% plus the dollar denominated. CME backslash CBOT pricing mechanisms enable simultaneous global disruptions. The biblical parallel, ancient staples remain foundations to global trade. Horse and chariots, transportation and logistics. The modern equivalent, container shipping, human trafficking, the bodies and souls of men. And so when we really think about this right here, it is speaking of now. It's been speaking of the world ever since John saw this vision. And so Revelation 18 kind of ends with this: for in 1 hour such great riches came to nothing. Every shipmaster, all who travel by ships, sailors, and as many as trade on seas stood at a distance. For in 1 hour. Never before has there been a chance for a market to collapse in an hour. We see that during the Great Depression back here, it took over 4 years to get from peak to trough. We saw that in flash crashes, kind of like COVID, if we didn't have backstops and if everybody lost faith in the global markets with technology, we've seen it with bank runs. There's no in 1 hour this is possible. And so I want to leave you not with fear, but I want to leave you with one of my favorite verses, Proverbs 22:3. The prudent see danger and take refuge, but the simple keep going and pay the penalty. At the end of this article, I kind of talk about what we can do to prepare, but all we can do to prepare in such a circumstance like this is just pray, give it to God, and just know, not just trust, but truly know that He has it. He has us in His hands. No matter what happens, we'll be fine. When the merchants of these things who became rich by her and stand at a distance for fear of her torment, weeping and wailing and saying, alas, alas, that great city that was clothed in fine linen, purple and scarlet, and adorned with gold and precious stones and pearls. For in 1 hour such great riches came to nothing. Every shipmaster, all who traveled by ship, sailors, and as many as trade on the sea, stood at a distance and cried out when they saw the smoke of her burning, saying, what is like this great city? They threw dust on their heads and cried out, weeping and wailing, and saying, alas, alas, that great city, in which all who had ships on the sea became rich by her wealth. For in 1 hour she is made desolate. We'll be fine, okay? So this is not... I know that seeing this is kind of dramatic, but I do it because I want it to be dramatic. I want to show you the fact that, we think that with our investments, we think that living our day-to-day life, that it's normal. But when you think and you see the fact that it took... I got rid of it. It took 102 years for the Dow Jones to reach this point right here, 10,000. And in the past 26 years, we've gotten to here. It'll make you rethink what you're doing in life. And that's what I want y'all to think about, the fact that it's time to come to terms with where we are in history, and especially with the Iran war. And I hope this was a good video. I know I kind of went all over the place, but I just hope it was kind of not a documentary, but kind of a collection and a spewing out of knowledge that I kind of have, of studying and research. And I hope it was kind of coherent. I know that I ramble on. But I hope that you just get the baseline of this and just knowing that this is not normal. So when you see the stock market go up 1 to 2% each day, or seeing the flip-flopping that we've seen in the past year with the Iran war, when you see this is not normal, okay? Not normal at all. So just be wary and just trust God. Hope y'all have a great night. Thank you.